Good afternoon. My name is Thomas Seneca, founding partner of TM Wealth Management. I'm joined today with our Chief Investment Officer, Matt Hartson, for our webinar on weathering the storm, managing market fluctuations with confidence. And Matt, we've kind of timed this perfectly. Monday was a significant drawdown in the markets, and as of this morning, the markets are rebounding a bit. And it seems like that's been the experience throughout the first quarter and now into the second quarter in the markets this year. So I think we're pretty timely in this topic that we want to talk about, and maybe just kick it off for us, Matt. Give us kind of just a snapshot of where we are in the markets as of year to date so far.
Sure. Good afternoon, Thomas. Great to see you, and welcome everybody to the webinar. Great question. I mean, we certainly have seen some volatility, and I think that's a great spot to lead if we kind of put together a handful of items here from agenda perspective. First thing we wanted to look at was that recent market performance, and so let's take a look at that. And as I was pulling these numbers together actually yesterday to prepare, I was a little bit surprised. We've seen so much up and down and so much movements and really so much noise out there in the marketplace today. I expected the numbers to look a lot worse, and I follow this every day. So I'm assuming a lot of the people who are watching with us are surprised as well. But I really keyed in there in the blue box in the center. That's a 60% stock, 40% bond diversified portfolio. And despite all of the excitement, all the noise, it's only down a little over 5% year to date. And over the last 12 months, that same portfolio is still up 7.5%.
Yeah, it's interesting, Matt. When I'm having conversation with clients, they're concerned, obviously, because the current market environment is very uncomfortable. But they're hearing the market is down, 10%. The Nasdaq is down. The Dow drops 1,000 points. And when we pull up their actual diversified portfolio, the numbers are as you expressed here, they're in the kind of mid single digit returns. And I think it's important as we look at the markets to not get caught up in headline risk, right? What is the news organizations, what are they touting at that point in time? What are they trying to get across? And make sure that we understand that we're not specifically invested in the market, right? And our portfolios are designed specifically to deal with these kinds of shocks to the market. And
Yeah.
so it's not uncommon to feel like, hey, there's so much negative and headline news out there that is causing us to think that things are dire. And there are some things, of course, that are out there that create a lot of uncertainty and are uncomfortable. But when we look at the hard data, it hasn't been as significant as maybe it felt like.
Yeah, no, I think you're exactly right, Thomas. And I put together, a little bit of information just on the market volatility and some of those headlines you're talking about. And one of the things I always like to remember is newspapers, TV stations, they're all in the game of selling advertising. And so what sells? Of course, excitement sells, whether that's fear or greed or somewhere in between. That's what's going to sell. And so they really do key in on those downturns that you've seen, talking about 1,000 point drops, biggest point drop since whenever, all of those things that you hear. And we've seen that a little bit from the February highs. The NASDAQ and the S&P 500, the NASDAQ being very heavily weighted in those magnificent seven stocks, as is the S&P 500, have come into what we call a correction, a 10% decline off of those highs. But what's been a lot less talked about, at least in my mind, is some of these other asset classes, like developed international stocks, an important part of a diversified portfolio that I'm guessing you had a lot of questions from clients on over the last couple of years as to why are we in these developed international stocks? Well, here's exactly why. They're up 7%. If you noticed on that previous slide I was referring to a couple of slides ago, they're actually the best performing asset class over the last 12 months. Quietly, though, you don't hear that screamed about on CNBC when you're watching the news there. And then emerging international stocks are doing fairly well on a relative basis, about flat for the year. And bonds that everybody hated are actually providing doing what they're supposed to do, providing that nice diversification and positive returns for us.
Yeah, it's kind of almost like the portfolios, a well-diversified portfolio is doing its job. It used to be, a couple of years, I think it was 2022, bonds didn't do their job, right? When the markets were down, bonds were down as well. And it seems like now we're getting back to a diversified portfolio performing the way that we would expect, right? In a challenging, uncertain equity environment, we would expect growth, the Magnificent Seven, all of those to struggle. But we would expect that bonds and something, outside of the U.S. market would perform better than, kind of the growth elements within U.S. equities. And that's what it's doing. And so it just reinforces the need to maintain that diversification in the midst of some of these shocks. And it's also interesting, and I know we'll talk about this a little bit later in the webinar. Every year it's something. Something triggers the market because the markets don't go straight up. I don't know if you remember from last year, it was Silicon Valley Bank was the, kind of the big concern in the market is, the banking system gonna crash and all these treasuries that they're holding. And, that was a shock to the market. This year it's tariffs and the administration's lack of strategy and clarity of what's coming out of Washington. That's what's causing some drawdowns in the markets. But that's the benefit to having a diversified portfolio.
Yeah. Let me pull up that slide for you that you're referring to there. I wanted to get to the right one as we were talking about that. This is really one of my favorite slides that I always talk about with clients is there's always a reason to not invest, always a reason to kind of step away from the market. And this goes back to 1970, so a pretty extended period of time. And if you invested $10,000 back in 1970, you can see this is a little bit of a messy chart. So hopefully those who are watching have a relatively large screen to see this on. But there were a lot of things that took place during this time. Obviously really high inflation in the 70s. All sorts of different items. We had Lehman Brothers filing for bankruptcy, the '08 crisis, all of those things. But if you stayed invested through all of that, including the big Black Monday, your 10,000 turned into almost $3 million by the end of last year, despite that noise that's going on in the markets. And so I think you make a really good point that yes, the reason is different. This time it's the focus on tariffs and Trump policy and those sorts of things. But we expect certainly that the results will be the same. And toward that end, yeah, I think there was an interesting piece that Thrivent Capital put out actually yesterday that I was looking at and reading about. And they talked about historically, when you've looked at these market downturns, at some point they reach a bottom. And from an S&P 500 index perspective, what they said is that the index is positive 81% of the time 1 year later, with a median return of 24% as the market bottoms out, from these downturns like we've seen so far this year. So pretty good track record historically once we get some additional stability back in the marketplace.
Yeah, it's kind of like the old Wall Street saying goes, Wall Street's the only place where people don't like to buy stuff on sale,
Yeah.
right? And so, like we talked at the beginning, it's uncomfortable because these portfolios aren't just numbers. These are people's lives and futures and expectations. But it also is on us and our responsibility to look at these strategically and look for opportunities in markets like this of how can we have the portfolio be more efficient? How can we look for, maybe getting into some positions at better price points as we see some of this volatility? Because as we look at the overall market, yes, this year it's tariffs and what is that going to mean? And with, talk about, the Federal Reserve and interest rates and what that might, the implications there might be, it's all very uncertain and uncomfortable. But that's also the time to start to look opportunistically within the markets and say, are there ways in which we can, be more efficient with the portfolio and maybe get into some positions at a little bit better price point?
Yeah, I think that really brings up an important point where we can maybe talk about some of the strategies we have for how we sort of deal with this. And the first one we've already talked about quite a bit, and that's diversification. And this isn't, a lot of people refer to this as sort of that quilt chart for any of you out there who might do some quilting. What the colors are is constant. And then you can see the different asset classes sort of listed within them. And hopefully what you see is in terms of looking at this overall picture of the last 20 years is that the leaders change all the time. And that's why having that diversified portfolio makes so much sense. And as you mentioned, I think probably there are some opportunities to further diversify client portfolios with less tax impact as a result of some of these changes we've seen in the market year to date.
Yeah, I've heard it said that if you have something, if you don't have something in your portfolio that you hate, you're probably not well diversified. Meaning, there's certain things that are always going to drag in a well-diversified portfolio are going to underperform the broader market because some, as you illustrated here with this quilt chart, some years it's large cap, some years it's real estate, some years it's emerging markets. But you can also see those asset classes also are sometimes some of the worst performers, right? And so if you look at that broad diversification, the reason we do that is because we don't want any one asset class to kill the portfolio.
Yeah, really important. And I think the other key here is how leadership changes over time. As you mentioned, if we go back to kind of 2005, there emerging markets were straight across the top for a number of these years. Then they were also straight across the bottom. And we just mentioned earlier that the best performing asset class year to date has been developed market international. You can see last year they were up 4.7% compared to 25% for big US companies. And so I think that plays exactly into your point on you've got to hate something all the time. None of the clients were very excited last year about the international allocation of the portfolio. That's now the one that's leading on a year-to-date basis.
Right.
And I think sort of continuing that discussion, I'm going to find one other slide here relative to that I thought was very interesting to sort of talk about. Now I can't find it. Thomas, yeah,
Of course,
bear
that's
with me 1 second.
when you want to find the specific file, it never shows up when
Yeah,
you need it.
yes, that's exactly how that works. But well, I will come back to that when I can find it. I apologize for not finding that slide. I thought I had it set up there right in the next chart. But we can kind of continue with other things that we can control. One of the things I found with investors is when they're concerned about the markets, they want to do something. And so I think, Thomas, this is a really interesting slide from that perspective of how investor behavior impacts your performance over time. And so, on the
Yeah,
left here, you
Matt,
can
I think that's a really good point for us. It when we work with our clients, right, we put together what we call our strategic financial plan, which outlines timelines, cash flow needs, risk profile, and the goal here is let's stick to the plan. So when we get shocks to the market like this, we want to evaluate, are we on plan or off plan? And if we're off plan, what's getting us off plan? Is it spending? Is it investment performance? Is it saving? So that we can have a more detailed conversation about the actions we can take to get us back on plan. It's rarely ever a beneficial approach to be emotionally make emotional decisions in the midst of a shock to the market like we're experiencing this year with tariffs and some of the noise coming out of Washington. So it really is going back and looking at what is the game plan, what is the financial plan that we have, and let's stick to that. Unless some of the assumptions have changed, then we can go back and say, well, now we need to make some adjustments to the plan. Then how does that flow through to how we structure the investment strategy?
Yeah, absolutely. And having that plan in place, something that everybody's comfortable with. I mean, I think that's another good planning concept is you can talk with people about their risk tolerance, but until they experience an actual downturn, you never really know what your risk tolerance is. And there've been studies on that have shown if you take a risk tolerance quiz when the market's doing well, you score much higher than you do if you take the same quiz when the market's scoring poorly. And so I know that's something you work very closely with clients on is to determine what is that true risk tolerance and how does that work to help them achieve the plan.
Yeah. Matt, maybe talk a little bit about, kind of what we're looking at, what we're seeing and watching in terms of, kind of how we see some of these tariffs and interest rates and some of the noise, how we see some of that playing out in the broader market over time, whether it's, over the next 12 to 18 months. What are we looking at in the kind of underlying economic indicators to see where we the markets might go?
Yeah, so certainly some key things that we're watching day to day. What drove the market down yesterday? Well, Trump over the weekend talked about firing Fed Chairman Powell. We don't think he can do that. We don't expect that to happen, but there was a lot of discussion around that. That puts some, again, uncertainty to use the word that seems to be the word of 2025, I think, is going to come out to be uncertainty. Excuse me, put some additional uncertainty in the market. But we're continuing to watch that closely. Yeah, even the person who Trump would like to have replace Powell has given him guidance saying, let Powell do his job over the next 18 months. There's no reason to step in early on that sort of thing. His term being up next, mid-June of 2026.
Yeah, and
You
and on that, Matt, just to kind of highlight that, a lot of what we're focusing on is really what is actually getting done versus the noise that is coming out of Washington, right? I mean, the headline risk, we can, I think what we saw with the tariffs in the first quarter is the markets assumed the worst possible scenario of tariffs. And I think as the actual implementation of the tariffs started to come out, the 90-day pause, certain exclusions for electronics and certain countries and the negotiations going on, the market said, okay, it's probably not going to be the worst case scenario. So that's when we start to see the markets recover a little bit. But there's this constant noise that comes out that the market's reacting to, again, back to this uncertainty. So what we want to try and focus on is what is actually getting implemented, not the noise that is being generated out of Washington in terms of what they'd like to do, but what can they actually get done. And as you and I have talked, I think it's unlikely that they can replace the Fed chairman, even though they're making a lot of noise. But the market reacts to that, and we want to focus on what's actually getting implemented and not the noise that's coming out.
Yeah, I think that's a really good point because the current administration, one thing they're very, very good at is noise. They like to be on the front page of the paper, leading off the news, those sorts of things day to day. And so, I know as you and I have talked extensively, and if you look at the items that we listed here as we're saying, what are we watching? We're looking for a lot of actual quantitative data. What does Q1 GDP look like when we see it here on April 30th? Is it a temporary slowdown? Is it a signal of a turn? What is the inflationary data? The Fed pays the most attention to the PCE data that's coming out on March 28th. We had a pretty good inflation print here. I have the date wrong on that. That actually should be April, as I'm looking at that today. We had pretty good inflation print here with standard CPI. What does the PCE data, does that sort of confirm that and give the Fed more room to cut rates? Yeah, we're looking at our next inflation report in May, those sorts of things. But to your point, looking at quantitative real data, not the noise.
Yeah, and I think that's what we had coming into this year is a very healthy and strong economy, right? Unemployment still remains low. The most recent retail sales that came out, the consumer is still relatively healthy. They're still spending money, so people have jobs. They're spending money. Inflation is starting to come down. Now, all of that could, get derailed by some other shock that comes out of Washington, which seems to be the case these days. But I think it's important to stick to those fundamentals and understand that the underlying economy is relatively healthy, and focusing on those elements rather than some of the noise, whether it's through news organizations or out of Washington or even your neighbor down the street that is highlighting some of these things. But in an overall standpoint, the economy is relatively strong. And some of these shocks to the market and the economy, like tariffs, this talk about replacing the Fed chair, some of those things are a bit of a drag on the market and not allowing the strength of the economy to get unleashed because of some of these policies that are looking to get implemented.
Yeah, and it's always a balancing act. Some of that negative sentiment can become self-fulfilling if it's prolonged for too long. And so again, we've got to watch that closely. But I think for long-term investors, which is what our clients look like, and we certainly encourage them to be, these also present opportunities, opportunities for different types of investments, opportunities to do things like tax loss harvesting, maybe doing some Roth conversions, other things that can be attractive for and really improve the overall long-term results of client portfolios.
Yeah, man, let's dig down in those a little bit further and talk about, because we never want to sit still and just wait it out. There are always things that we can be doing from whether it's a diversification standpoint, looking at valuations and different opportunities, helping the portfolio be a little more tax efficient. Let's talk a little bit about some of the things that we would recommend that both folks that may not be clients on the call today on the webinar, some things that we are doing for our clients to still be efficient and make sure the portfolio is performing.
Yeah, I mean it's back to sort of that section we have on what can we control and what are some constructive things we can do to take make progress here during this noise that's causing these market fluctuations. The big one that jumps out to me is this idea of loss harvesting. One of the great things about the growth and proliferation of all of the new exchange traded funds or ETFs out there is you have the ability to identify maybe a certain fund in your portfolio that has a loss, sell that fund to lock in that loss, and then immediately purchase another fund. Now, you have to get a slightly different fund to avoid some IRS issues with what are known as wash sales when you do that. But the huge benefit to doing that is you can lock in that loss, maintain your market exposure. So if you take yesterday, for example, the stock market, the S&P was down 2.5%, 3% yesterday. Lock in the losses from there, switch to a similar but different fund. You maintained and you're seeing that growth today, but you captured that loss yesterday. And once you have those losses, you can use up to 3,000 of that to offset your ordinary income each year on your tax return. And you can then carry whatever losses you've been able to harvest forward indefinitely. And so I think a really powerful planning tool, if you can build up some loss carry forwards, gives you the ability down the road to further diversify, take gains in the future without taxes, or even if you are living off your portfolio, it's really attractive because you can sell appreciated stock later, offset those losses where you're generating some tax-free income to live on as well.
Yeah, and I think that's one of the key elements is we always want to make sure the portfolio is as tax efficient as possible. And I think one of the key things that you brought up, Matt, is when we do this tax loss harvesting, we don't want to lose the market exposure. We still want to maintain that diversified portfolio. So that's why we sell out of one position, but immediately buy a similar but different position that gives a similar market exposure. So we're really not out of the market and we can participate when things recover like they have today a little bit, but lock in that loss that we can ultimately utilize to offset future gains. And it really is a powerful tool because those losses, like you mentioned, you can use 3,000 off of your ordinary income, but say you didn't have any other gains throughout the year, those losses carry forward. We can use those, carry those forward to future years and just help the portfolio be that much more tax efficient.
Yeah, speaking of tax efficiencies you're talking about there, that's kind of our second one here, which I think is definitely if you have people who aren't clients, obviously we'll talk to our clients about this directly, but if you're not clients on the call, something you want to really think about is this idea of doing a Roth conversion. So if you've got money in an IRA that's pre-tax money, now that it's fallen and maybe it's worth 5 to 10% less than it was at the end of last year, converting that then is going to have a lower tax bill for you because you're converting a smaller balance. And the great thing about doing that is once you've converted, all of the gains going forward in the future are completely tax-free to you. So if we see that recovery, I was talking about the median recovery off of some of the lows is 24%. You convert $1 million into your Roth IRA, you're getting $240,000 of growth that comes from that you don't have to worry about paying a dollar in taxes on.
Yeah, I mean, it's pretty powerful, I guess, especially as we talk about long-term investors, having multiple tax efficient buckets to pull money from in retirement or as you look to accomplish some of your financial goals is always a better strategy so that we're not adding more tax unnecessarily and we stay within certain tax brackets as we get more strategic about how we distribute funds out of some of these accounts, whether it's a taxable a pre-tax or a tax-free Roth IRA, and really looking at some of that this year, given that we've had some drawdowns in portfolios to be able to get a lower tax impact on some of these conversions.
Yeah, I think that can be pretty powerful. Yep.
Yeah, and I think, Matt, we're going to be able to take a few questions. So if you're on the webinar, there should be either a Q&A box or a chat box. Feel free to put those in there. We'll bring Christine on here in just a minute. But kind of some final thoughts about this, Matt, and some of the conversations I'm having with clients is this is the reason for the drawdown in the market is different this year, but this is kind of a normal occurrence within the markets. And I don't know if you have that graphic, Matt, that shows each year the drawdowns in the markets and then where they ultimately finish. But this is what when you invest in the equity markets, in the stock market, what you're getting compensated for is the risk premium, right? If the market went straight up with no potentials for going down, then I think the overall returns that we would get and would expect would be significantly lower. So the volatility is what we're getting compensated for for staying invested, right? And this graphic is great. You can see, over the last, this is 50 years almost. You can see there's always been years when the market, is down, right? And you can even look, the last 2 years that have finished in the 20% range, we've had 10 and 8% drawdowns in those years and still finished up. So I think it's just a key reminder that markets don't go straight up. Our job as your wealth advisor is to help you stick to the plan and then look opportunistically within the portfolio. Are there ways that we can be either more tax efficient, or are there areas that we want to get into that now may have a better entry point than they did, earlier in the year? So it's not just to kind of sit back and wait it out. It's, hey, we can utilize this market to, increase tax efficiency and maybe enter into some positions at better price points.
Yeah, I think that's a really good point. And this is one of my favorite sort of tables that Fidelity actually put this together. And, you know, if you invest in stocks, historically you've earned greater than 8% returns. And in fact, in the last, given the strong record we've seen over the last couple of decades, it's probably over 10% returns you've earned. But you have to put up with a lot of noise to get there and a lot of uncertainty to use our specific word. And that's, three corrections of at least 5% a year, one correction of 10, one greater than 15, and one greater than 20 every 6 years. And, we've certainly seen that. And I think, going back to that chart you had there, look at a year like 2020. We saw a 34% drawdown and still finished up 16% for the year. And so definitely this volatility is uncomfortable, but also very normal.
Yeah, and I don't want us to paint a picture that is entirely rosy, that everything's going to be great. And I think there's a lot of headwinds that we're facing in the markets and in the economy, given some of the policies that Washington wants to implement, a lot of the uncertainty that the federal workforce feels around job security, and funding of different programs and those kinds of things. So it's not that we think that, hey, it's just going to be smooth sailing from here. I think what we're emphasizing is let's try and focus on the fundamentals, the data that we're receiving, and then utilize that data to be as efficient with the portfolios as possible, both tax efficiency and investment returns, rather than just closing our eyes, putting our head in the sand, and hoping that 3, 5, 6 months from now that we get the all clear. So there are definitely some headwinds that we're going to face. There's increased volatility that we're going to face, but we're focused on the underlying fundamentals and looking at portfolios in a way to be more strategic.
Absolutely. I think that's really important, as you said, taking the right types of actions during these times of market stress can really benefit the clients over the long term.
Right. Well, great. Thanks for the time today, Matt. Let's see, Christina, if there's any questions. Again, you can either click the Q&A box or put something in the chat. We want to be respectful of people's times. We'll just take a couple. If we don't get to your question, we're happy to respond to you directly with that via email. And if needed, happy to jump on a phone call to talk about your specific needs and questions. Great. Christina, any questions out there?
Yeah, here's our first question. Where do you think interest rates are going given the current market volatility?
Yeah, great question. Matt, do you want to kind of kick that one off?
Sure. I think predicting the interest rates are tough because of a lot of the uncertainty that you've talked about out there. But I actually think I expect to see interest rates pretty much range bound throughout the remainder of the year. If you look at sort of the underlying fundamentals, we've got inflation that, as you mentioned, has come down. We're kind of in that 2.5-ish range now. Tariffs at least are expected to have some impact on that short term. So let's say, inflation kind of stays in that 2.5 to 3% range. We've got a little bit of inflated market uncertainty. We've seen a little bit of dollar weakness as well, and we're continuing. You mentioned some of the cuts, and obviously, the federal government is trying to work to get the budget under control. But I certainly don't think they're going to be incredibly successful on that front. It's certainly been a battle for a number of years, and I don't think they're going to win that this year. Hopefully, we'll make some progress. But if you put a sort of a premium on top of that, 2.5, 3% inflation, I think we're going to see rates in that 4.5 to 5% on the 10-year Treasury. I think they'll be kind of in that range as we get in and move through the end of the year. Now, that the big wild card there, of course, is recession. People are starting to use the recession word a little bit. That could cause those rates to fall a bit for us. But I think, at least from our forecast perspective, we're seeing slowed economic growth, but continued economic growth, sort of avoiding that recession. In which case, I think 10-year Treasury rates in the 4.5 to 5% range feel really high to us because we were used to such low rates, particularly coming out of COVID. But if we look back more historically, that's a pretty normal rate, and I think that's probably what we'd expect to see this year as well. Thomas, any thoughts from you on that?
Yeah, I would just, the Fed has come out and said, even for them, this is a challenging market environment for them to make decisions on. And I think they're going to be more cautious about making rate changes until they see some specific data in terms of what the overall impact of tariffs are. The other thing that we've got to, kind of have down the road that we're eyeing is we're expecting some sort of tax package and deregulation, which also might, lessen the inflationary impacts of the tariffs. And so, there's a lot of moving parts right now that even the Fed is not prepared or not seeing any clarity in terms of how to deal with their rate policy. And so they're going to kind of have a wait and see things. I think, as you mentioned, Matt, the big thing they're going to look at is, hey, if we are getting close to a recession, I think that's when they might jump into action and start doing something with rates. Great. Christina, any other questions at this time?
No other questions, but as Thomas mentioned, we will be sending a recap of this webinar. So if you think of anything, feel free to respond to that email and we'll get your questions answered.
Great. Thanks, Christina. Thanks for the time, Matt. Just kind of a parting comment. At TM Wealth Management, our job is to help our clients make good decisions with their money. And as we go through our planning process and the investment strategy, we work collaboratively with our clients to help them achieve their desired outcomes. If there's something that we can do to be helpful to you, or if you have specific questions, don't hesitate to reach out. We appreciate the opportunity to be helpful. With that, Matt, it's great to spend some time with you. Thanks for all the insights, and everybody have a great rest of your day.
Thanks, Thomas.